Listen, if you're a wholesale account executive and you're looking to make a change, looking to get something new going on with a fantastic company, Remin Wholesale is looking for you. They'd love to chat with you, man. For a completely confidential chat with those guys, no problem at all. Just click the Remin banner you see right here, over on your right.
Well, welcome to the National Real Estate Post. We are here with our good friend Barry Habib, who I'm sure all of you are very interested to hear from right about now, based on everything that's gone on. Barry, before I bring you on, just want to say it has been a rocky road lately, but you guys have been forecasting to the T along the way, keeping everybody posted on what's going on and how to react to this. So, man, what's up? What's happening? And what can we expect here going forward here?
Well, thank you so much, my friend. Hope everybody's doing great. So, yeah, we've been in for quite the ride, haven't we? We saw rates kind of zoom up very, very short period of time, then took a dive lower. Now kind of back on the rising path. Has a lot to do with a few things that's going on. So one is, listen, we've talked about this in the past. The Fed is buying less. They've been doing this in stages over the past several months. Started in October, where they started purchasing a little bit less. That resulted in some higher interest rates in the subsequent period. They actually purchased even less in January. And what did you see? Interest rates moved up after that, right? Did it again in April. Interest rates moved up after that. So they're going to do this again in July. So here's the heads up. Be careful, because you'll see that. Now, we also got some inflation data that was a little bit, not terrible, but a little bit of a move up in inflation, especially on the wages in the jobs report that we had seen. So the bond market doesn't really love that. So all of these things are working against us. Now, why did rates have this crazy move lower? And it's what we said, hey, it's kind of a head fake. We don't believe it. Here's why. It's because in Italy, you remember, of course, we had in Great Britain when they were exiting the European Union, we called that Brexit, right? Well, we've got a name for this one. If Italy leaves, it'll be Italy, okay? So that will be the name that we're going to put on this one. That does occur. Then you can see a flood of money coming into the U.S. And let me explain why. Okay, this has to do with currencies. So I just want you to think about what happened and why rates dropped so much. And we had talked about this before it happened to our subscribers. Those of you who are subscribers, you know this. We said, listen, part of what we see going on is a rush for Europeans to take money out of the euro and put it into dollars. Why? Because while you put it into dollars, you can buy things like mortgage bonds and treasuries, and you'll make the yield, which is small, but you can make money on the currency. Here's an example. If you took 100,000 euro and, before Memorial Day, you put it into dollars, you had to transfer them into US dollars, so you got $1.23 for every euro. That's great. You took those $1.23. So if you took 100,000 euro, that's $123,000, and you bought either mortgage bonds or treasuries. Now you're going to get a small yield on that, right? But just a few days later, as news started to come about with Italy having a lack of a government being formed, maybe leaving the European Union, that sent some shockwaves through, and the currency changed. It went from $1.23 to every euro to $1.15 to every euro. So if you did that, and if you then said, hey, I want to take my money back into Europe, now the exchange rate being 1.15, you made essentially overnight roughly 6.5–7% on your money overnight in bonds, okay? Plus the yield that you get, which is small. But this is what we saw happening. So now that things have calmed down in Europe, people are saying, okay, look, I made money on that trade. Let me take that money back to Europe, and you're seeing a little bit of selling in bonds, and now almost a return to the previous trend, which is now thinking about the Fed buying less, now thinking about inflation, and that's why we will probably see interest rates move a little bit higher. Now, how much higher? Frank, I think that we probably challenge that 304, even get up to about 312 on the 10-year Treasury, so watch that. I think we're going to get there, but the next real stop, and this is going to be important, was 3.35 on the 10-year Treasury, and again, I do think we get there, especially after July. We started talking about this. Fed's going to be buying even less. I think after July, we get towards 3.35 in the 10-year Treasury. One last point. It's so crazy when people say, 5% mortgage rate, that's high. If you look at the last 50 years, there's a chart we put out for our subscribers, the last 50 years, for the last 50 years, rates are up here, right? And then if you look at the last piece here of the chart for the last 7 or 8 or 10 years here, when you see where rates are, we're all in this box. If you were Rip Van Winkle and you woke up and you said, man, any place in here would be great for me, right? Well, that's where you are, okay? So it's still okay.
Gotcha. So, okay. Yeah, I mean, obviously, overall, big picture, rates are still just insanely great. No issues there. But, of course, it can be, as a loan originator, a little stressful working with buyers on a daily basis. Everybody's still concerned about their rate, regardless that even though they're so low, they're still concerned about it. So it's obviously good to be aware of what's going on. Understand that looks like, you're seeing possibly 3.35 on the 10-year after July or something like that. So obviously there's going to be a trend of some rise. Yes, still overall great rates, but still your borrowers are going to want to know what the heck is going on. You know what I mean? So
let's talk for a minute big picture, right? So look, what you're doing today in loans is planting tomorrow's refinances. I'll tell you why. Because if you look at history with a 100% correlation since World War II, every time the unemployment rate bottoms out, you get a recession that follows subsequent to that. When you have a recession, you're going to have interest rates drop dramatically. You will have a chance to refinance all of these people. So what I'm telling you is just look at the big picture. Number one, the real estate market's great. It's going to remain hot. You've got huge appreciation. Get people in their homes now. You'll have a chance to refinance them. Even though 5% is not a bad rate, 5 1/8 won't be a bad rate, you'll have an opportunity to bring them down under 5%, maybe in the mid or low 4s within the next couple of years. I'm very fortunate and blessed. As you know, Frank, I've got a lot of people that I'm close with in friendships and close relationships with that are some of the smartest minds in the world. I mean, John Walden's a dear friend of mine, Art Cash and Peter Bookvar. I have dinner regularly with these people. And when we do, all of us, all the things we're looking at within the next couple of years really points to recession. Back to that unemployment rate bottoming out. And we just saw a 3.8% tick on the rate of unemployment in the last jobs report that we got. What that means is that the unemployment rate's still dropping. But it wouldn't surprise me that over the next 6 or 8 months, we see that kind of bottom out. And then as it starts to reverse, a few months after that, maybe within 12 months, we start to see signs of a recession. So we're not counting on a recession this year, maybe at the end of 2019, but certainly within 2020 is when most of us feel is kind of like a good target zone, maybe a little before, a little after 2020, where you see a recession, which means you're going to probably see an opportunity for lower rates around there. So look, I know adjustables for a lot of us, they're not that exciting or that attractive, but if you could save money on a 7 or a 10-1 ARM, save the money, because if it's better than a 30-year fixed, you're never going to reach after 7 or 10 years because you'll refinance or move within that time. Right. So just think about that and explain this whole philosophy we just talked about to your customer, because if it makes sense to them, they'll say, oh, that's a good opportunity.
Man, we're kind of going along, but now I just have to ask you though, is if you're feeling like we're seeing recession, at some point, maybe in the 2020 range, something like that, based on all the information, does that also mean we'll see home values cool down?
Such a brilliant question, and I'm so glad you asked it, because if you take a look at the last 6 recessions we've had, housing's performed exceptionally well. So how could that be? People look at the last recession and they say, oh man, they're in a great recession. Wasn't the housing bubble, wasn't the recession what caused the housing bubble? It's the opposite way. The housing bubble occurred first, brought us into recession. And if you look at the entry and exit point of the recession and you take the Case-Shiller Home Price Index, it's relatively flat during that period of time. Why? Because interest rates dropped quite a bit to counterbalance the effects of the recession, also helping to make it a little bit easier to buy a home. Now, this was different circumstances too with the housing bubble. So you almost have to take it almost as an anomaly.
Yeah.
But the previous recessions, home prices actually increased during those recessions.
Wow, that is fascinating.
Yeah.
Okay, well, good to know.
Your customers.
Interesting stuff. So we got to get out of here. We kind of went long, but great information. I know everybody appreciates it, Barry. Really want to thank you very much for being on the show again. You guys, you can try MBS Highway for free, which I really suggest. There's a link down below. You try for free for a couple of weeks. Get in there and have Barry guide you around and help you navigate through the interest rate waters. It's going to be very, very beneficial.
There's so many things that we have to help to be a resource for your realtors. And by the way, team, look, the message is this. Things are good, okay? It's easy to get down. You see rates go. It's easy to get discouraged. Don't. because long-term, this is really good stuff for us. This will provide us health for the long-term. It's good for our customers. They'll have a chance to refinance. They'll get into a home. They'll make money on that home. You guys will do transactions today. You'll do the refinances for them. We're in good spot right now. So even though rates are going up a little bit, we're still in a really, really good spot.
Interesting. Super awesome. Great to have you on the show, as always, Barry. With that, you guys, do us a favor. Leave us your comments down below. Barry gets in there as best he can to respond to you.
I will.
And also, this is a video definitely worth sharing amongst all the realtors out there, your realtor partners with your lender partners, and even with your consumers, just to let them know kind of what's going on out there. So do us a favor and share the video as much as you can. With that, Barry, thanks so much, man. Really appreciate you being here.